talking about with a President-elect Biden. There'll be some overlap of what I talked about in October, and I'm just going to bring that back up and highlight that. General housekeeping, again, if you're coming on, whether it's computer or the phone, if you would please just make sure that you're muted. You should have come in muted, but if you somehow unmuted yourself, please put yourself back on. We'll do questions at the end like we normally do, and you can do it via phone by unmuting yourself, *6, or if you're on the computer, you can hit the chat button and send me questions along the way, and I'll be sure to address them at the very end. So with that said, today we're going to kick it off with Gina Slayton. She's one of our investment advisors. Been with the bank for a couple of years. She's new to the Bright Ideas WebEx, so be patient and kind to her. I know she's super, super nervous. I'm just joking. She's a pro at this. But it's nice to have another new face. I think Adrian did the October one, and I've mentioned this before. Our goal when I do these is to bring in new faces as much as we can from time to time. Our wealth management group is roughly 60 people deep or so. Our investment team is there's about 20 of us on that team. So I try to bring them in, let them all have a chance to give their opinion of the markets and talk about things. So I'm going to let Gina kick it off, give a little bit of a recap, an outlook of the rest of this year and what 2021 might look like, and then I'll pick it up from there. So Gina, it's all yours.
Well, thank you, Jason. Everybody for tuning in. As Jason mentioned, I'm Gina Slayton. We're going to give a little bit of a recap of the wild ride we went on this year and our outlook for next year. I know it's the end of the day. I'll try to keep it as brief as possible, but a lot did happen this year. So we'll try to go through as much of that as possible. 2020 was the year of the virus, and I don't know about you, but I am glad to see this year come to a close. It was a very difficult year, one of the most extraordinary times of our lives that we've been through in the recent past. I'm looking forward to the fresh start of a new year, but let's kind of recap what we went through last year. So going into 2020, at the end of 2019, we did expect volatility for a couple of reasons. One of that was simply our bull market was over a decade long. And we also knew that there was an upcoming presidential election. But bull markets don't simply end because of old age. We didn't know if we would continue on this trend or there might be a recession. And then came the coronavirus pandemic. No one predicted this pandemic. Speed and contagion of the virus was unlike anything our world had seen in over 100 years. Regions began, rightfully so, imposing restrictions to try to slow the spread of the virus. But our economies came to a near standstill. It was a scary time. No one knew exactly how long we would have to endure these shutdowns, what the damage would be. Forward-looking estimates became near impossible to calculate, and some panic did set in, understandably so. 500 stock market was down 34% in March from its recent very highs. We saw 22 million people out of work, and our unemployment rate skyrocketed to 14.7%. On the economic front, not much better news. Just in the second quarter alone, on an annualized basis, our GDP was down over 30%. But thankfully, we saw prudent, aggressive, and coordinated stimulus come quickly. Two-sided, we had the $2 trillion CARES Act from Congress, as well as monetary policy from the Fed. Fed slashed short-term interest rates and also expanded their balance sheets to historic proportions. With this and better understanding of medical therapies and better understanding of how to operate businesses in this environment, we saw the fastest recovery from a recession and bear market in history. So I show this in visual terms. I'm a visual learner, so this S&P 500 chart goes back about 25 years, shows that bull market that I mentioned coming out of the great financial crisis, and then the deep drop that we saw so quickly in March. Amazingly, our stock market has reclaimed their losses. S&P 500 achieved recovery from those February highs in about 6 months. And again, we've reached brand new highs here again last month. The economy also posted better than expected results. As you know, this recession was unlike many others we've seen in the past. It was more of an event-driven recession, more like a natural disaster than any type of bubble that we saw in the last two recessions, being the tech bubble and the great financial crisis. This hit our lower term workers harder than anyone else. At one point, 40% of workers making less than $40,000 lost their job at some point this year. We have seen gains on the unemployment side. I mentioned we reached almost 15% unemployment in April. We have dropped below the 7% mark. We still have our work cut out for us, though. We've gained about over 12 million jobs, but still have 10 million fewer jobs than at the beginning of the year. So the recovery is not over quite yet. In terms of economic growth, economists predict that we'll end the year with an economy about 3 to 4% smaller than last year. Negative numbers are never a good thing, but it is a brighter scenario than had been predicted in the spring when our economy was completely shut down. We started to see that uneven recovery begin in the third quarter, led by strength in technology, e-commerce, healthcare. That really started that rebound. Continue to see positive data on the housing front with automobiles. This is offsetting some weakness, some obvious weakness that we've expected in the service industry and areas of restaurants and tourism, which we all know will be the last to fully recover. And one of the greatest news we've received recently is highly successful vaccine trials. 3 different companies from Pfizer, Moderna, AstraZeneca, they all appear to be above 90% effective. November saw a huge bump in the stock market as they were only pricing in vaccines to have an efficacy of 60 to 70%. Much better news. With this, we saw our rally turn broader. So earlier in the year, some of our areas of concern were the fact that this rebound was concentrated in too few industries. We all know e-commerce, online retail, home improvement, grocery stores. But within the last month or so, we've seen cyclical value stocks up a lot of that ground compared to their growth counterparts. We all saw small cap companies up 20% in November alone. They had also lagged their large cap counterparts, so it's good to see broadening of this rally. Conflicting signals remain. In the short term, we are keeping our eye on some positive and negatives. On the positive side, we have healthy consumer spending, new home sales at 14-year highs, household debt service at 40-year lows, which is good, net worth, household net worth at historic highs. These are good numbers. But unfortunately, we still have rising COVID cases. We hit an unfortunate mark yesterday in over 300,000 American deaths due to this virus. Economic restrictions still remain in place, and our economic activity has flattened out a bit. So with all this information, these conflicting signals, we see actually that the market is looking past the short term. Markets tend to be forward-looking indicators historically, so this makes sense. This is not to say that the short term won't be bumpy. We do think that the short term is likely to be bumpy, but the end of this pandemic is in sight, and we can finally anticipate some better days ahead. Thank goodness. So let's look forward a little. One of the things that we've been seeing with clients recently is that there is a high amount of cash on the sidelines. That's normal human nature. We expect more bad news in times of unease and stress, but we all know that cash returns are dismal, and that's not going to change anytime soon. So instead of waiting, let's focus on slightly longer term, see what we can expect for next year and beyond. So we do expect fundamentals to catch up to that market surge that I mentioned. Many of you have probably heard from us that a full recovery simply cannot be achieved without putting this pandemic behind us. So vaccine distribution, first on the list, that's key. We got the great news of the 3 vaccines. The US authorized the first of these on Friday. Trucks have already gone out this week with vaccines, the doses being distributed, starting with priority groups like frontline healthcare workers and long-term care facilities. We expect flat to unimpressive for the next few quarters as we muddle through the winter months. But we do start to expect to see a tick up likely in the summer months. A few reasons for this: we see divided government there. The presidential election is behind us. This produced a divided government. It wasn't a red wave or a blue wave that was predicted. So with that outcome, a second round of stimulus is very likely. It's also much needed. And this configuration also probably means that there's limited changes to the Tax Cuts and Jobs Act of 2017, continued easy monetary policy. We like that. With these multiple vaccines in play, more fiscal stimulus round 2, we'll finally see that release of pent-up demand, spurring consumer spending in the areas hardest hit by the pandemic. We all want to go out, spend money on entertainment, dining, travel, leisure, and even some routine medical procedures that either we've been putting off or unable to do this year. So with that, economists up around about 4% for 2021. And amazingly enough, corporate earnings are expected to be up over 20% next year. So all these signals suggest positive single-digit returns for stocks in 2021, not quite at the level that we had seen in 2019 or 2020. Those were pretty extraordinary years that both years have been in the double digits. But the most likely scenario is probably somewhere around the 3 to 6% range for next year. I also like to focus beyond just next year. Looking a little bit more of the longer term. This is from JP Morgan, and I think it's good for us to look at some of the drivers of long-term economic growth. And in the top left, one of the is growth in the working age population. In the past few decades, this has declined. We expect this to decline further. We've known that the baby boomers are aging, hitting that age 65 and retiring, coming out of the workforce. Also going into these numbers is our birth rates and immigration. These are also dropping. So this does highlight going forward the importance of legal immigration. On the bottom left, we have capital stock, growth in capital stock, which growth in capital stock has slowed as investment spending is barely outpacing depreciation of that capital. And in order to increase productivity, increase that GDP number, we do need to increase the quantity and quality of equipment, tools, workers, which has been slower here recently. Factors, we see our output on the right, our GDP. Going back to about 1950, we can see that the average was in the percent range, and past few decades has been in the 3% range. And with the two factors that I've just outlined here, we're more likely to average around the 2% growth going forward than 3 or 4%. So with this in mind, we think a full recovery is likely near the end of 2022 or the beginning of 2023. And once we get to that point, conditions are likely to return to where we were back in 2019, which was defined by slower growth, low inflation, and low interest rates. So switching gears slightly to life after the election, the one event that we could predict, something that we knew would happen, we didn't know the outcome, but knew that it would happen in 2020, was our presidential election. Volatility, as many of you know, is just the swing of market prices. Volatility increased significantly in September and October leading up to our election. When neither the blue nor the red wave came to be, markets breathed a sigh of relief with the outcome of a divided government. I have here a reference to the runoff race. That is the caveat to a lot of this. There's still 2 U.S. Senate seats up for grabs in the state of Georgia. Very important election because if the Democrats win both seats, the Senate will sit at 50-50. Any tie in the Senate would be decided by the vice president. So Georgia is unique. The reason that we're in this situation, and I won't go too in depth because I think Jason's going to touch on this later, but to win your Senate seat in Georgia, you have to exceed 50% of the vote. None of the candidates went over that threshold. So historically, runoffs in Georgia have favored Republicans. In the past, Democrats have simply been less likely to turn out for a second round of voting, especially when that first round came in a presidential election year. But everything's changing. We're in a changing world. Demographics are changing. Too close to predict what will come out of there. But the most likely scenario is that divided government, Democrats sitting in the White House, Democratic control of the House, with Republican majority in the Senate. So with that being the backdrop, here are some of our expectations from an incoming Biden administration. As mentioned before, we did a second round of stimulus. This is simply a bridge to get our economy through to the side where our economy, our country is mostly vaccinated. If this hasn't happened before the January inauguration, this is top priority. Second, Biden is expected to be slightly more predictable on foreign policy, staying tough on China, but using a new approach from President Trump and using our allies to pressure China from a multilateral front. With this in mind, the more predictable nature, this should give added support to global trade and produce above average potential growth, which is good. Third, without Democratic control of both the Senate and the House, Biden will likely have to use executive orders to push through some of his agenda items from the campaign trail. These include more regulation on large tech companies, clean energy initiatives, things of that nature. Executive orders are in nature less impactful overall than working through Congress, so that's something to keep an eye on as well. Enough, a bright spot that could bring about bipartisan cooperation is an infrastructure bill. This means much needed spending on our bridges, our roads, our airports, subway systems, and our broadband networks. This is actually near the top of Biden's priority list once we get the pandemic under control, because he knows that it is a bipartisan issue. Lastly, and probably most troubling to North individuals, is Biden's tax proposals. I'll go through a few of them briefly on the next slides, but I do want to mention that these are proposals and would need widespread support to become law. So the first of his proposal would be a tax on high earners. Biden proposes rolling back favorable tax cuts that came in 2017 for individuals earning over $400,000 a year. This would raise their highest tax bracket to 39.6% and reduce their ability to itemize deductions. It would kind of bring them back to a level as if they were in the 28% bracket for those itemized deductions. If this becomes the case, some strategies that we would look at, if there were large traditional IRA balances, we could look to see if it would make sense to convert some of those to Roth dollars while tax rates were still historically low before the changes were to take place. Next, Biden favors increasing capital gains taxes. As many of you know, the highest long-term capital gains rate currently sits at 20%. And Biden proposes for individuals making over $1 million that this top rate increase again to 39.6%. In this same realm, he's also in favor of eliminating the step-up basis, which is a generational tool used to let beneficiaries avoid taxes on gains accumulated before death, which would potentially mean, if this change comes to be, that more taxes would be due on wealth passed to these beneficiaries. So in this case, we would look to lifetime gifting strategies, as well as irrevocable trusts could become more important than ever. Third proposal is reducing the estate tax lifetime exemption. So currently this exemption is at a fairly high level. An individual pass $11.58 million to his or her heirs, so double that for a married couple, without paying federal estate taxes currently. Any amount currently inherited above that amount is taxed 40%. Biden proposes to lower that 11.58 million threshold to 3.5 million. And any amount above that also proposes to tax that extra amount at 45%, up from our current 40%. So again, here, more that we could look at: lifetime gifting, use of trust for planning purposes. So I'll repeat that these are proposals, not guaranteed to, but definitely keeping a close eye here. With that said, we believe in our investing principles. The vast majority of investors should stay fully invested to their target asset allocation. Timing the market is nearly impossible because too many correct decisions have to be made in the right order. This chart here at the bottom of the page illustrates what happens in the first 100 days of a new administration. So this shows the difference between missing out on those first 100 days of a new president's administration versus simply staying the course. So the end result, if you keep your money invested, stay the course, is a value of about 46% more in your account than if you had tried to time that. While we're talking about time-tested investing principles, many of you have probably seen this chart. It's very important not only to stay invested, but to stay diversified. It's almost impossible to predict which asset class, which sector, which region of the world is going to be a top performer in any one given year. This colorful chart goes back 20 years, but the pattern remains that there actually is almost no discernible pattern from one year to another. The only one that we can see is if you look towards the middle of your screen, we have that black box, the diversified portfolio. And this approach just has thoughtful allocations to each of these asset classes. What you'll notice, though, is it's the very top of the performers, more importantly, never the very performers. So on the right, you can see the average over the last years. That diversified approach came in the top half of performers with less risk than most of its counterparts. So on the next slide, I want to focus on an area where sometimes our clients are not as enthusiastic to invest, but there's good reasons to take a hard look at having a meaning allocation, and that would be to international assets. So let's think global. We do tend to have a recency bias looking at domestic versus international investing opportunities. True that the US has outperformed their global counterparts coming out of the great financial crisis from 2008 and 2009 up until now. We may have forgotten, though, that international equities were on a tear starting in about 2004 up until that point. So going back at least 50 years, market performance has regularly alternated between US outperformance and international outperformance for many periods of time. So we think it's a good time to take a look here, a data-driven look at your international allocation for a couple of reasons. The dollar is weakening. This trend started in the spring when the pandemic set in. We have sizable trade deficits. We saw a surge in our fiscal deficit. There was also a convergence on global interest rates. There had been a fairly widespread in interest rates you could receive throughout the globe, but because of the pandemic and resulting crisis, federal banks quickly dropped their rates to near zero. Lastly, increased risk appetite as of late helped the weakening dollar. And a weak dollar is beneficial to US investors like us who hold assets in other countries. Second, attractive historical valuations. International valuations, as measured by forward price to earnings ratio, are much closer to their long-term averages than our domestic valuations. Higher potential returns than here in the US. So analysts, with mind, analysts for in Europe, returns next year could be somewhere in the 6% range. Emerging markets expect somewhere in the 8% range, which is a little bit higher than what we had talked about for our domestic market. Third, automatic diversification. We know how important diversification is. We just talked about it on the previous slide. And we also know that international markets are more value oriented. They're more heavily tilted towards financial and energy sectors and less towards technology, which our US markets are heavily weighted towards technology. This automatically provides great diversification compared to an all domestic portfolio. So something to keep in mind there. And with that said, I hope this next overview for you today. I hope you heard some interesting information and maybe took a few tidbits away. But we want you to know that it's actually a great time to review your financial picture at the end of the year. You have almost 12 months under your belt. You have a lot of data to look at. So it's a great time to review where you sit from a tax perspective, especially if you're somebody who pays quarterly tax estimates. You can also look at your income. This is an extraordinary year. Does that mean more income for you, less income for you? How does that compare to years past? And what can we do with that information? We also want to look at your emergency room. What's your cash situation look like? Is it too low? Do we need to build that up? Or is it high and maybe we need to put some excess cash to work that's actually for long-term goals and not your short-term goals? We just need to know that your Stockyards team here is hard at work for you. There's a lot that we do at the end of the year. A lot of it is behind the scenes, but it's really important work. You may know that we have a lot of internal committees, both on the investment side as well as the administrative side. We have our fiduciary oversight committee. We have our investment strategy committee, manager due diligence, our individual core equity teams. All of these groups are meeting very regularly. We talked about a lot of changes that happened over the year, and these groups are meeting to make sure that we stay abreast with these changing issues and how that trickles down and actually affects your lives and your portfolios. Rebalancing is very important. Every few years, we revisit our investment policy statements, which is our mutual understanding of where to target asset allocation. So if we ever get too far out of the bounds of that asset allocation, we'll make sure that we bring that closer to that target allocation that we both agreed on. I mentioned taxes before. This is a very important time to make sure that we look at any tax advantageous moves that we can make in your account. One of those is tax loss harvesting. That simply means looking at, are there any positions in your portfolio currently sitting at a loss? And does it make sense to book that loss and offset it to capital gains that we've taken earlier in the year? Also on the tax front, you're a mutual fund holder. The mutual fund companies at the end of the year, it's very normal for some mutual fund companies to pay out capital gains distributions. So we take a look at that. Does it make sense to continue to hold that mutual fund and take that capital gain? Or does it make sense to exit the mutual fund, hold an ETF for a period of time and not realize that capital gain there? It's the end of the year, around the holidays. Gifting strategies often are very important at this time, whether it's your family members, friends, or charitable causes that you care about. So we help you decide, does it make more sense to gift in cash? Does it make more sense to gift in appreciated stock? And from which account? Is it better from a taxable account or maybe from your IRA? And these are different benefits that we can outweigh and help you decide. Tactical moves, we talked about the tactical move today, making sure that you're looking at your international allocation. Are we up to a full weight there in terms of where your portfolios currently sit? You know, as I mentioned, our committees are meeting on a regular basis, and we're taking a look at how the world is going to change going forward, how we can continue to be invested so that we participate on the upside, but don't participate as much on the downside, try to help protect you on the downside as well. Distributions are always very important. We want to have open dialogue, as much lead time as possible to understand what distributions you're expecting from us. The more time you can tell us, the better, so that we can be on the same page. It's not as beneficial if we wait until the last minute and don't know about upcoming distributions. So the more time we have, the better we can plan for that, instead of having to have a fire sale or something of that nature. And lastly, we know that there's a lot of different life stages that you and your family are going through, and we're here to provide any guidance that we can. We have some great financial planning software. We can take you through multiple different scenarios, whether that be retirement front, whether that be talking about long-term care, or any other scenarios that might come up. We hope we're a good sounding board for you to help you and your family make those decisions going forward. That's really all I have today. I know Jason's going to take over. Again, we'll probably do questions at the end, but if you have individual questions about your situation or your accounts, feel free to reach out to your advisor, or you can reach our department mailbox here on the screen. So I'll let Jason take over, and we'll wait for questions at the end. Mute.
Thank you for the reminder.
No problem.
Now, thank you, Gina. Well done, and I appreciate the comments. You know, her last slide, I can't put enough emphasis on what's happening behind the scenes. Although when we go through it, it seems small on that PowerPoint presentation of what we're doing, but that tax loss harvesting, managing capital gains, all those things are actually very powerful at the end of the day, more powerful than most clients will ever realize. And it takes a lot of time juggling all those things behind the scenes. So again, can't put enough emphasis on that. And it's been a wild ride, as Gina mentioned, since the election. You know, the market's up, I think, its biggest run in history since following an election. And a lot of that's really a lot of different things. And it was the vaccination news being a big part of that. And, you know, if there's any letdowns out there, well, I think the market's pricing in the success of the vaccines and it becoming more widespread, and we've just seen the start of it. Again, I want to talk a little bit about taxes and estate planning. And you know, we try not to predict the future or anything, but what we're trying to really do is help plan for it with clients. And with President-elect Biden coming in, as Gina mentioned, you know, all eyes are on Georgia right now. So right now, if you're watching the news, if they're not talking about the vaccines and they're not talking about Trump's denial of losing the election, they're probably talking about Georgia. It's one of those three things right now when you're watching the news. Nothing but it. Maybe a little bit of snow. You know, they're calling for a little bit of snow this week, and that could be the end of the world too. But in seriousness, everyone's focused on Georgia. While we think it would be worst case a split in that runoff, you know, we see one Republican senator elected and one Democrat senator elected. The House or the Senate would remain in control of the Republicans. You know, we don't know what's actually going to happen. And as crazy as 2020's been, you know, the Democrats might pull off both seats, and then it really throws a lot of things into a whirlwind. Again, not that anything's going to happen immediately. We want you to be prepared for it. And a lot of what I'm going to talk about, you know, it doesn't affect all of our clients. You know, it only affects some, and it'll affect others in different ways, and probably not at the capacity maybe that we're talking about today. But as Gina mentioned, there's no better time than to review your estate plan and your investment allocation and portfolio than today. It's the end of the year. There's changes coming. We know that. Good time to review things. And also, as already mentioned, don't forget to review income. You know, maybe this year was a down year, maybe because it was a COVID year and you're a business owner, or you had a loss of hours and you had reduced income coming in, but next year is going to be more normalized. I tell clients to try to look at not just this year and next year, but what's it look like, if you could predict a little bit 2 to 3 years out, that actually can help with decisions we might advise you of. Because if you think you're going to have lower income years or higher income years coming up, we can plan for that a little bit better. We can try to take more income in one given year and maximize tax brackets, or take less investment income one year because we know you're going to be in a higher tax bracket already. So those are good things for us to know. Again, I'm going to I'll go through this fairly quickly, but Biden's economic policy is stated potentially increases spending by $7 trillion to upwards of $9 or $10 trillion. It just depends on what source you're reading through there. And it's partially going to be funded by $4 trillion of additional tax revenue that's planned. If the Republicans remain in control of the Senate, it will be hard for him to raise the $4 trillion in tax revenue that they're hoping for. But they might find workarounds or other ways. But that's kind of how they would fund it. As presented, the policy now, if it was able to be passed in the law, we would see obviously increases in not only corporate tax rates, but also households. Not all households. So right now the thought process is if you're married and filing jointly and also filing single, it's going to be tax regulations would affect you at the $400,000 income and higher for most situations. Again, there's a lot that's going to happen for that to be able to work out that way in 2021. I could see, maybe Democrats win both seats in Georgia. I don't know that something happens immediately and for 2021. They have a lot of things on their plate right now, and one is making sure the economy recovers, stimulus, COVID. So I don't know that it necessarily impacts us in 2021. But the ultimate goal of Biden and his team is really to roll back President Trump's jobs and tax cuts, and how they're going to do that will be the gamesmanship that will start on January 20th. So estate planning under a President Biden, as Gina mentioned, right now exemptions are at all-time highs, a little over 11.5 million per individual. So if you're married, that's a pretty significant amount of money that can pass tax-free. The goal there is that will pass back to Trump's tax cuts in the Jobs Act of 2017. So it'd go back to at least the 5.8 million roughly, if not the 3.5 million that's been tossed around quite a bit. So we don't know exactly where it would fall, but would be pretty confident that it would be somewhere 3.5 to the 5.8 if they're able to get their way. Again, that's the multi-million-dollar question. So if you're someone that's more cautious by nature, you might be wanting to start planning on how you could maximize exemptions in 2020. You'll need some help with an estate planning attorney potentially if you don't have the proper trust already created, but gifting money into trust such is one way ultimately to protect those assets for the future. But let's just say we get beyond 2020 and we are caught off guard in 2021 and they're able to bring back exemption levels drastically. It's you as you look at your household, you're not necessarily handcuffed, and it's not the end of the world. There are other tools out there, and I've listed just a couple: the GRATs, the CLATs, and the defective trust. There are tools out there where you can still pass money. That growth would be sheltered and passed tax-free to your heirs, but it wouldn't be as significant as what you could do under today's regulations. But just want you to know it's not the end of the world if something should happen quickly and catch everyone off guard. As we keep looking through this, as I mentioned earlier, 400,000. That seems to be the income level that's being targeted. So if you're above that, you're likely going to see pretty substantial tax increases if these cuts were rolled back somehow. If you're below that, there should be no change. At least that's what we're being told from President-elect Biden's policy. And if you read through it, it mentions that there will be no changes to those that are under that 400,000. again, top tax bracket going back to 39.6 at the individual level, you get there right at 400,000. So it hops very quickly. If you're a married filing jointly, you will hit 35% for just a short little while under the at the above 400,000, but it won't take you long to jump also to 39.6. Long-term capital gains, again, heard this already a little bit. In qualified dividends, they would increase the ordinary income tax levels. Again, this is going to be for our top 1%. So if you're making more than $1 million a year, that's a potential risk. Again, not saying that we're overly worried about it for 2021, but it's something to think about for beyond that. And that kind of comes back to that conversation where both Gene and I have mentioned, on an annual basis, when you're reviewing income, part of that review is where investment income and your capital gains and dividends, and reviewing, what's that going to look like in any given year, because it could be your taxes could be impacted based off of what those flows of investment income are going to look like. And then also the proposal to eliminate that step-up basis. So if you have maybe a mom or a dad out there that has $1 million in an investment account, a taxable account, let's just say $700,000 of it is all capital gain, so it's growth. Under current regulation, if they pass away, that steps up to $1 million. So you receive those assets at the cost basis of $1 million. You could sell it and diversify it and not have to pay any taxes, essentially, or very little, depending on how far past the date of death that you sold it. President-elect Biden would like to see that go away. Either the step-up goes away, or they're also talking about a death tax, so they would just assume that those assets were sold and they would tax the estate on that $700,000 immediately. So those are common topics being presented. And something to think about. So as I mentioned earlier, I was kind of going through a little bit, married filing jointly. Once you hit that $400,000 mark, which is right here, you've got a little bit of a cushion actually you have no cushion in the 39% tax bracket, so you jump immediately, and so do you at the individual level. For some reason, I was thinking you still had a little bit of cushion married filing jointly, but I'm wrong. So it's a quick jump. So it's going to be something new for you if you have to go through that. Again, planning for that will be critical. Again, other things that are going to come back potentially would be different types of credits out there when you're filing your taxes. So if you have children of the right age, so they're going to be minors. The child tax credit is proposed to raise from $2,000 to as high as $3,600 for children under the age of 6, and then for all other children that are over that age but under 17 would be $3,000 a child. And then the dependent care credit, this has a pretty substantial move, so it's going to go from potentially could move from $3,000 to $8,000 per child. And if you have 2 or more children, it would go from $6,000 to $16,000. So that's a pretty substantial credit that you would see. First-time homebuyer credit, which you used to hear a lot about, would potentially be reintroduced, and it could have an available credit up to $15,000 with certain restrictions there. And then they're also proposing a caregiver credit. So if you're someone that's been caring for a loved one, and it's been taking up a lot of your time, you can actually get a credit for, so they're proposing a $5,000 credit. Other significant things, and this is for really business owners here, the qualified business income tax deduction, which is really for pass-through businesses, partnerships, LLCs, S-corps, and sole proprietors largely. So you might be an investment firm, you might be a law firm, a CPA firm, those types of practices. If your income is going to be above $400,000, you'll lose that QBI deduction, which ultimately could increase your taxes thus again by another 10%. So, again, everything about what I'm saying, if it worked out for Biden's, for his team, everything I'm saying, it involves a tax increase and very little breaks. Something that's actually pretty substantial is the proposed flat retirement contribution credit. So for those that retire, contribute to a 401k right now, you know, let's just say you make $50,000 a year and you're contributing $10,000 to your 401k. Well, that $10,000 offsets your $50,000 of income, so therefore you only have $40,000 of taxable income. In this case, what they want to do is they're just going to say there's a flat retirement credit, and it'd be set at 26%. So if you're putting $10,000 away, you'd actually, now you're only going to get a $2,600 credit towards your income deduction. So that's pretty substantial. And because of that, we would expect to see higher income earners potentially shift away from contributing to their traditional 401k and possibly mixing it or splitting it or going 100% into their Roth bucket, because you're going to have such little credit anymore for that contribution. You might as well maximize it for the future, and potentially contributing to your 401k Roth bucket makes the most sense. Same type of deduction change for itemized deductions. Now, with the tax laws that changed years ago, the itemized deductions have largely gone away for a lot of filers, and you're just going to take your standard deduction because it's become so large, roughly $12,000 and some change. Now, if you are still itemizing, you'll be capped at 28%. And so that largely hurts, again, you're more affluent, you're probably your upper 1%ers, 5%ers, you know, your wealthier households. They're going to be not getting as much of a deduction. Now, there's ways to manage that. In rolling years, you would accelerate some deductions to lump them together, so that in every couple of years or every other year, you have larger deductions so you can maximize and be a little bit more powerful with your deductions. So there's certainly ways to manage through all these potential proposed changes that might come through or might not. Again, my job here today and Gina's job here today is not to alarm you, concern you, or make you pick up the phone and call your CPA or your estate attorney. It's just for you to be aware of potential things that could come down the road, so that you can start planning for it. Corporate tax rates, they'd increase to 28% from 21%. That's not overly necessarily alarming if you kind of look at the market. I don't know that doesn't impede or stop the stock market from having a great rally. You know, if you remember, before it dropped down to 21%, we were at 35%. So there's still a break there. Company earnings are still pretty strong, but it would be a drag for some companies for that tax increase. And again, something you might not be familiar with, but for those out there that maybe have a lot of real estate investments or other investments of hard assets, 1031 exchanges would also be eliminated if your taxable income's over $400,000. So for those, you know, I'll use apartment buildings as a common example. If you owned maybe a 4-unit apartment building and it had a large capital gain and you wanted to get out of it, you could transfer into a like-kind property and defer that capital gain with the new property, which is what they call a 1031 exchange. But for a lot of individuals who are doing things like that, they're gonna lose potentially that opportunity to be able to do that. So again, just to kind of recap, if you're planning for year end and beyond, you know, high income earners, those in corporate America, maybe that have a lot of stock options, you might want to look at where your vestitures are, and if it makes sense to maybe accelerate income this year if you are worried about what happens in Georgia, what happens to future taxes. Roth conversions, again, going to be a popular thing for quite a while. Either using Roth monies in your 401k aggressively or making conversions from an existing traditional IRA into a Roth if you feel like today is going to be your lower tax bracket. If you don't think that retirement will bring lower taxes, then you want to do it. If you think for sure you're going to be in a higher tax bracket in retirement, then that Roth conversion makes sense. And if you don't use those Roth monies, they're great assets to pass on. They're great assets to use maybe for college funding if funding wasn't didn't work out as well as thought by your children as they were saving. You know, we all know college expenses are exorbitant, so that's another neat little trick to be able to pull off. And then, you know, looking at capital gains. So back in March and April, who would have ever thought we'd be talking about being able to have a chance to really take a lot of gains? Here we are at the end of the year, and we've seen a tremendous rebound from the market. An unbelievable month of November. December's been pretty strong too. And the market's going to end, knock on wood, substantially higher than we ever would have thought for the year. And it might make sense to kind of take some of those gains off the table this year if, again, you're going to be worried about 2021. I'm not necessarily all that worried about it. I've got hopes that we'll stay a split Senate, and there'll be enough obstacles there for all of these things to be happening too quickly. Not to say that it won't happen in the future, but at least it won't happen suddenly or quickly. And then as you're planning in the future, you know, you might want to have a plan in place. Maybe you do own some stock that has large capital gains, having a divestiture plan in place for, you know, how you're going to be efficient in getting out of those gains if the potential for capital gains is increasing for you. Again, that's going to be for the select few. Your income's going to have to be pretty high for that to be a worry. It does bring up the use potentially of municipal bonds if you can find one to buy. Again, that's the inventory there is tough for high quality municipal bonds, but you know, you could flock to that market to save taxes there on your fixed income investments. Dividend paying stocks, you know, be efficient. Actually, this comes back to, and it could be an entirely whole different conversation, but there's something you may have heard been mentioned before, but it's called asset location. And what that means is if you have an IRA and a taxable account and a 401k and a Roth IRA, where you locate those investments actually becomes very critical. And if we're in higher tax situations, it becomes even more critical. And where those purchases are being made and where those dividend paying stocks and fixed income paying individual bonds or funds are being held can help you with tax efficiency in the future. So you kind of want to be cautious of that. Again, I mentioned contributing to Roth 401ks. And then, you know, we are at the end of the year. So right now we're working with a lot of clients on planned gifts. They're making their last minute gifts for the year. And this might be a good year. If you've got some cash on hand, you're in a good place, you might consider accelerating charitable gifts and maximizing that this year. You know, maybe rolling what you had planned for 2021 into this year. Something to talk to your advisor about, even your accountant. And if you're making cash gifts, this year is certainly a great year to maximize that. So if you're making cash gifts, the CARES Act allows you to donate up to 100% of your AGI, so 100% of your adjusted gross income. So if you made $100,000 this year and you had the capacity of being able to gift, let's just say $100,000 in cash, you would essentially minimize and zero out your taxes. But anywhere between 0 and 100 would be very powerful on your tax return. And again, you know, might not happen this month, probably won't happen this month, but I would challenge you to, if you're worried about anything that's being mentioned today, you know, meet with your advisor, meet with your estate planning attorney, and review your estate plan. And when you're filing your taxes for next year, really have a more thorough conversation with your accountant on, you know, what's advisable. Work with your advisor here at Stockyards. Have those two collaborate and come up with a plan that might be better than what's in place. So I apologize. I did cover that quickly. I didn't want this to drag on too long. We will mail out this presentation so that everyone will have it. Again, if anyone has any questions, you can always email us at wmtquestions@syb.com. Again, always feel free to ask your advisor. And if anyone has any questions today, I would ask that you chat that question in from the computer or *6 your phone and ask us now. We'd love for someone to give us a question. I don't know, we've had a question in the last couple of Bright Ideas. Gina is looking to get stumped, so help me out here. While I wait for any questions to come through, again, it was an unbelievably challenging year at times. And back in March and April, you know, we, as part of the investment committee and all the other committees that we have within the bank, looked at each other many a days wondering how are we going to get out of this, what's going to come of this. You know, it was quite the whammy that we were dealt. But the Federal Reserve showed us its resilience and their dedication of they are not letting this economy fail. It's going to cost my kids and probably some of your grandkids out there a lot in taxes in the future. I think we crossed 27 trillion in debt this year, and there's more to come. But again, they are dedicated to making sure that we recover. Because the one thing I don't want you guys to forget is that before COVID, the economy was really strong. You know, it was a slow and steady recovery, but we were at a really good place. So we don't want that to be forgotten, and we'll overcome the COVID, and the economy once again will show its strength. So with that, I don't see any questions. Be on the lookout. I don't know how 2021 will do these bright ideas, if it'll be monthly, quarterly, but they will be out there. So continue to look for these invites. I'm going to try to come up with something new for 2021 to be a little bit different, more engaging, really try to get you lured in, and hopefully you walk away learning something, and maybe even telling a neighbor or a coworker, and with what you said, giving them enough of an impression that maybe you'd want to make an introduction to Stockyards Bank. So for those of you that stayed on the call here to the end, appreciate you guys as clients, and hopefully 2020 ends healthy and safe for you, and 2021 kicks off prosperous and healthy for you also. So I hope you please enjoy your holidays, your family if you're able to see them, and please reach out to your advisor if you have any questions here at the end of the year. So I thank you for tuning in. Take care, everybody.
Thanks, everybody. Bye-bye.